Hi everybody, JU here, and let's move forward with the mechanics of the markets and the methods. Now, in my last video, I had gone over the rifle charts. Okay, this is the main weapon, and it's composed of the stochastics, the moving averages, and the Bollinger Bands. Three household simple ingredients. However, when you meticulously converge them together with the right recipe, well, you know what? It's like taking basic ingredients like styrofoam cups and gasoline. You create napalm. Same thing here. Same concept applies. Alright, so with the rifle charts, once again, let's review real quick. Here's our moving averages. Alright, the moving averages, this is the roadmap, because you have the trend. In this chart, we have an uptrend. We have a rising 5-period moving averages, means higher highs, higher lows, higher highs, higher lows. 15-period moving average. Okay, it's rising, so that's an uptrend. Now, this uptrend peaks out and then sells off. When the 5 crosses the 15, that's called a breakdown, and then from that point, it goes into a downtrend. The stochastics, that's your momentum engine. Now, real quick about the stochastics. You have your 20 band, your 80 band. The conventional definition or usage of the stochastics, you have bands on the axis, 0 to 100. Above 20 or below 20 is oversold, above 80 is overbought. Your basic rule of thumb is when the stock falls, stochastics will fall. When they fall into the 20 band, it's considered oversold. And it's not until they cross up through the 20 band that triggers a buy signal to go long, because it's making a bounce. On the flip side, if the stochastics rise above the 80 band, that means they're overbought. However, it's not until you get the crossover through the 80 band, okay, where you get a sell signal or a short signal back down. So this is your stochastics engine. These moving averages, that's your roadmap. Taken individually, you got all your haters. They say moving averages, man, they're laggard. They're laggard. History, how's history help you? You got your stochastics. Once again, you have the haters, okay, that will say, well, stochastics, they're not consistent, meaning that a 20 to 80 band move, okay, in one time period, this same move can happen again in another time period and have nothing and have nowhere near the type of price movement that you saw in the prior time period. And they're right. If you're only going by the stochastics alone, it's not consistent. If you only go by the moving averages, yeah, they're moving averages. How do you get an average? You have to have your highs and your lows. So it's by nature, moving averages, they're going to be laggard. Okay, they're going to be laggard, but laggard doesn't mean bad. Especially when you understand that there are 7 time frames. Lucky number 7. There are 7 time frames that matter. And you talk about going back in time, or a time machine, right? With these 7 time frames, they fall under the principle of linearity, which states that whatever type of pattern that forms on one time frame, on any given time frame, if it is a strong and consistent pattern, it's going to apply on a wider time frame. But here's the beauty. The rule of thumb is the wider the time frame, the bigger, the longer the time frame. Okay, you have a wider price range, but you also the moves, the underlying moves resonate stronger. I kind of see the time frames as the ocean. The shorter time frames are shallow. Okay, first of all, let's go to the time frames just so you know what I'm talking about. The 7 time frames go from 1 minute, 5, 15, 60 minutes to the daily, weekly, and monthly. So your 1 minute, that's your shortest time frame. That is the most shallow time frame. So that's like the surface. That's the surface of the water on the ocean. And as you get a little deeper into the time frames, as the time frames get longer, 5 minute, 15 minute, you go deeper and deeper and deeper until when you get to the monthly and the weekly, you're talking about the most strongest undercurrents, way below the surface, But those undercurrents are strong. They're the strongest. So with those 7 time frames, understand that with the intraday trading, where you don't hold positions overnight, where you're trying to profit by gaming the price action. In other words, buying low and selling higher, buying high, selling higher, shorting high, covering low, or shorting low and covering lower. Okay? Profiting off those price fluctuations intraday, where you basically close out your position and your exposure completely. Okay, that's intraday. Your main time frames are going to be the 1, 5, 15, 60 in the daily. Now when you're actually trading, you can narrow it down to the 1, 5, 15, but you always have to keep an eye on that 60 in the daily. Now the daily, weekly, monthly, well, those are the wider time frames. On the onset, it looks like, all right, well, maybe I don't have to concern myself with the wider time frames. I'm not swing trading here. I'm not investing here. And true. But the wider time frames, we understand the wider time frames, the wider they are, the stronger they are. So those same moving averages, which I call bumpers, let's just call them bumpers, like on a pinball, on a pinball machine, okay, or a playing field. These are bumpers, okay. As they hit, boom, 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 they're going to react. So the bumper price levels on wider time frames, if the stock is trading near those bumpers, then yes, they do apply. So that's why it's important to always gauge the values of these wider time frames. Okay, if your stock price is within the average trading range of any of these wider time frames, which means the 5, 15, 20, 50, 200 period moving average, or the upper lower Bollinger Bands, okay, of the daily, weekly, monthly. And all you got to do is just jot it down. That's all. Now, with these wider time frames, doesn't matter how strong a wider time frame is, if the shorter time frames do not converge, meaning they move in the same direction at the same time, they can't trigger. Alright, so you could have you could have a nuclear warhead that is dormant, but the damage can be earth shattering. But it's not going to matter. Doesn't matter until that fuse is triggered with the shorter time frames. And therefore, in one sense, it's an advantage if you understand that concept and you know that no matter how strong those wider time frames are, the shorter time frame is what detonates the wider time frames. As long as you can stalk out the wider time frames, it's a matter of time. Oh, that trigger is going to detonate. The question is when. The 5 and the 1 minute. The 1 minute, it's mainly that's a detonation. Now, convergence of the time frames, okay, that pretty much means they're moving in the same direction, and they trigger. On the downside, what we have here, 1 minute comes down, 5 minute, 15 minute, and the 60-minute stochastic peaks out. Convergence to the downside from left to right, 60, 15, 5, 1 minute. On the flip side, to the upside, 60 minute, 15, 5, and 1 minute. Left to right, convergence. Look at the stochastics, look at the engine. Do you notice how all 4 of these engines are crossed up, moving up, crossed up, moving up, crossed up, moving up? It's a beautiful thing. And look at this. Look at this price appreciation, 34 to 37. Look at that. Look at that. It's a beautiful thing. And you know what? When you look at something like that, it's very easy to say, wow, you know, well that's kind of easy, Jay. You know, so all I got to look for is 4 price lanes. I just got to look for, 4 sevens on that slot machine, and I'm golden. It sounds simple, but it's not. Because by the time you get to this, transparency has completely shown its face. See, the name of the game is to find transparency before it becomes too transparent. By the time it becomes too transparent, by the time you see something like this on your charts and you hit that buy button, well, what do they say? When you sit down at a poker table, you look around and you can't find the mark, chances are you're the mark. Well, that's exactly the same situation. It looks beautiful. It's too beautiful. The problem is transparency has been hit. The dotted lines are the upper Bollinger Bands. And you'll notice the upper Bollinger Bands already hit and overshot in the 60. Already hit, overshot on the 5 minute. Already hit, overshot. And overshot means that trading at or higher. Okay, already hit. Yes, the 15-minute chart has maybe 25 cents more higher, but every other time frame's already hit their upper Bollinger Bands. And if you hit that buy button and step in now, you're the mark. Okay, you're the mark. Because when it gets this beautiful, it's too damn late. This is beautiful. This is something that you put in textbooks. But this is not something you're going to make money off of. Because the way you make the money is not getting in here. It's getting in here. You see the green candles, and you see that single red counter candle. You see that divergent counter candle. Okay. You see how when the price rises, What do the stochastics do? The momentum indicator, the engine. What does the engine do? It crosses and bounces back up. That makes sense. But once we hit the upper Bollinger Bands, you always will have profit takers. You always will have shorts, bears, and they will come in and they will test the fortitude of that bounce. Now remember something. Remember how when we talked about the 4 phases of trend, the one phase you don't want to mess around with, well, it's phase 1. And what happens in phase 1? You get a lot of head fakes and you get a lot of chop. Boom, 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 boom. Boom, 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 boom. Phase 1. Boom, 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 boom. Phase 1. Market makers routinely will short and cover. Short, cover, short, cover, short, cover. Okay? Oscillation traders, they will short cover, short cover, short cover, short cover. So, as you can see on GNRSC right here, you can basically eyeball that range. First of all, got to give credit to the rifle charts to visualize that. But you notice that 37, look at 37 peaks out. Pullbacks, 36.50, 36.60. But that's a range, about a 50-cent range. After a while, people get used to that. 37 shorted, take it back down. 37 shorted, take it back down. So what happens when that range tries to break, as we see here? The same oscillation traders, the oscillation algos, okay, market makers, they're going to come right in and say, oh, all right, that's nice. They blew it up a little bit. Let's go ahead and routine. Basic routine. Let's short it right back down. And there's your red candle. But something interesting happens. When they try to suppress it and take it right back down like the prior oscillations, you notice something. The 5-period moving average this time holds the support and continues to rise. And when the high of the body of the counter candle, in other words, you get 2 or 3 green candles, you get a red candle, or you get 2 or 3 red candles, you get a green candle. Okay, the high of the body, and that's the highest point that the shorts came in. When that breaks, what that triggers is buyers. And guess who the first buyers are? The shorts. All right, the late shorts. They're going to say, oh, screw this, man. I need to stop out. And the way they stop out is what? They got to buy. And that buying pressure triggers more shorts. That buying pressure triggers longs that have been watching this range and realize, oh, man, this thing's breaking out. And they jump in and they leapfrog each other. And then the next thing you know, the stock goes parabolic. And when you look at the stochastics, when they short, when the oscillation players come in and say, okay, all right, we need to put an end to this. Okay, yeah, it overshot the range a little. Let's put an end to this. And they try to suppress it and muscle it down, and they can't. But when they first do try to suppress it, muscle it down with that counter candle, what happens with the stochastics? Excuse me. They try to take it back down, just like they did right here. Just like they did right here. Just like they did right here. See how the yellow, the lead stochastics, crosses down for an oscillation? They're trying to do the same thing, but guess what happens this time? Stochastic stalls, ready to cross down, but instead it slopes back up. It slopes back up at the high of the body of the counter candle. And when that happens, that triggers this phenomenon, which I call a mini pub.